This is the Daily Market Rundown live from the Tradelo trading floor. It's March the 18th. Some highlights from today's show. Bitcoin is now in play, the dollar is due for a bounce, and gold fundamentals are healthy. Good day traders, and welcome to the Daily Market Rundown. A little bit of a wrap on the European session. It's almost identical to yesterday, which was identical to Friday, which was mostly identical to Thursday. The reality is volumes are light. We of course have had to contend with the roll, which seemingly now is through. We are all trading the front month being June when talking about the US indices. Think Russell, think Nasdaq, think S&P 500. So with that in mind, with the roll now mostly out of the way, we will start to see the markets perhaps begin to trade a little bit more technical, and of course we can then re-engage into those US indices. Now with that in mind, of course Europe has had a pretty good session, and there's some good reason behind that. We do have of course Putin and Donald Trump speaking today to discuss the potential truce. So Europe seems to be getting a little bit ahead of that, but also don't forget Europe is still very upbeat given the fact that the Bundestag is now effectively due to vote and agree to some fiscal relaxation in Germany. So it's all positive in Europe, and that is expected to follow through into the US session, but it's all going to be dependent, of course, on what the outcomes of the Putin and Trump discussions are. With that in mind, let's turn our attention to our first topic for today. Before we get on to, of course, Putin and Trump, Nvidia is in play for today. It's going to be a key proxy market to watch as Jensen comes out and gives us a little bit of an update. There's a couple of things to watch out for, but again, I don't want to go too specific into the details because I'm not sure that necessarily matters. I think what matters is ultimately how the stock trades against what gets said. Keep in mind, we closed yesterday around that $120 mark, which is a little bit shy of that resistance around that 127 area. So there is sort of what we call free space to the upside, should he say something meaningful for the market. Equally, we've obviously got quite a bit of downside towards that 110 area of support. So the point is the market could very easily go bid or offer from this point. And again, it's not that he's expected to come out and say anything new. I think the key takeaways, or the key sort of context which Nvidia finds itself in, is there is still this concern, of course, long term about the demands for Nvidia's chip stack, and is there going to be as much demand for it given what we're seeing from some of the LLMs in particular in China. So I think that's one to watch out for. Again, I'm not sure a CEO is going to come out and be very negative on his company and tell us that less chips are required. I'm not sure that is in play. But again, we have to be open-minded to these things. So just keep a close eye on the news headlines, and in particular, keep a close eye on the stock price of Nvidia. It was the best performing stock, of course, last week in terms of the Mag 7. So it will likely drive the sentiment over the course of today's session. But with that in mind, I think the key sort of news flow is going to come from Trump, Putin, and I think very much context matters here. So let me shape it for you in the best way so you understand it. As of now, Ukraine has agreed to the terms the US set out for a ceasefire, which means that they have agreed to whatever the US ultimately has laid out in front of them. There's a minerals deal, there's agreement to give away some land, of course, to Russia, and of course there is some other parts of that agreement we don't yet know about. Okay, the details on what Ukraine has actually agreed to has been very, very few and far between, and there's obviously logic behind why it's been done this way. But the point is Ukraine has agreed to it. Now, Ukraine agreeing to it doesn't necessarily mean Russia's going to agree to it. We know that Ukraine did make some serious demands. One of the key demands they made was they will not give up any land. And so again, the fact that they tend to have agreed to whatever has been put in front of them suggests that they do find the deal works for them. Okay, now that doesn't mean it's going to ultimately work for Russia. Russia has, of course, said they get to keep all the land they've annexed. Russia also says there will be no NATO or any joining of NATO in the future for Ukraine. Russia's also demanded that they have limited troops in Ukraine, and Russia's of course come out today and said that if there is going to be a truce, all arms to Ukraine must stop immediately. So the point is that the concessions coming from the Russian side seem like a very, very tall order relative to ultimately what the Ukrainians have told us they want, and yet the Ukrainians have already agreed to a 30-day ceasefire. So the point is, going into this, I'm skeptical. Okay, that's the point. Is I'm skeptical. I think many participants are skeptical that there will be a ceasefire. It feels like ultimately, this does need to go down a couple of more discussion points before we get to it. And I think importantly, if there is skepticism around getting some form of a deal, the real trade opportunity then is if they do manage to agree to a truce. Okay, I think that's the key takeaway today. It's not that Russia doesn't want to agree to a truce, it's just they want to agree to it on their own terms. Okay, so there is a strong possibility that we do get some form of agreement from Russia, and should we get that, that will be taken quite positively from the market, because it seems like there's still this massive divide between what Ukraine is saying they want and what they've now agreed to, and what Russia is saying ultimately what they want and what they're willing to agree to. So that's the point. I think going into this, it's almost like if I was going to assign some form of a probability, I'd say it's 80% not likely to go ahead with a truce in its current form, and 20% likely to go ahead. And with that in mind, I think that's how you have to trade the markets. Okay, we'll get a more favorable move on an agreement of a truce versus a non-favorable move should there be no truce. Okay, also keep in mind, no truce does not mean we won't get a truce. It just means back to the negotiating tables and more negotiation required. Now, one thing to note, Rubio came out, I think it was on Friday or over the weekend, and he said, look, it's tough negotiations, there's a lot going on, and this may be something that takes a couple of weeks to really iron out. We also heard Putin say that on Friday. He came out and said, look, he's looked at it, but there's a lot that still needs to be discussed. Now, I'm not sure an hour and a half or 2 hour discussion with Donald Trump on the phone is going to be sufficient to iron out some of the things that Putin was referring to. And one of those was, look, we've got a 2,000 or 1,000 kilometer border. How's that going to work? Okay, so I think there's a lot that still needs to be discussed. But again, think of that 80-20 today. If there is an agreement to a truce, it's very positive. Okay, and I think that's how you have to approach the news flow today. Now, with that in mind, there's a couple of charts that are very interesting. We'll start off and talk a little bit about Bitcoin, because I think it's actually in play. I think it's one of those that it's now or never. It's a now or never moment. I think it's quite binary. I think the price action of these last 4 sessions has been quite telling. You can see it's done absolutely nothing, despite the fact that the US equities seem to be just slowly finding a bit more positive sentiment. Now, I think Bitcoin is leaning on a very similar pattern to what we saw back in July last year. So if you go and have a look at that chart formation, you can see we had the correction with the equities. We ultimately plunged below that 200-day moving average, couldn't do anything for almost 2 weeks. The market just sat below that 200-day moving average, almost signaling quite a lot of weakness. All of a sudden on the day, we got a nice strong close above that 200 moving average, and then we staged the bounce. I think it's a very, very similar formation, very similar pattern in play. And I think today is that day that if Bitcoin is going to go up, I think today's the day you are going to see a strong close. You get a strong close, I think we're going to get a multi-day rally where we'll maybe perhaps come back up towards this 90,000. We know that that's been significant support for a good 6 months now. So no surprises if we do get back up to that 90,000 over the course of the rest of this week. However, like I said, if sentiment does start to sour, if the equities do start to roll over, of course, we are below that 200 moving average, and we could very much find ourselves back towards that 78,000. Okay, but base case, I do think Bitcoin is going to push higher today. It looks as though it's set up for that right now. If you look at Bitcoin, it's down 1.5. So I think a key signaling will be we trade flat on Bitcoin today. Don't be surprised to see us all of a sudden up 1.5, 2% on the day. Okay, Bitcoin is very much in play. If I'm going to lean anyway, I think it's slightly bullish on the day. I do think we get a nice little bit up in Bitcoin. But that being said, the real play doesn't come necessarily today. We close above that 200-day moving average, and I think you get the real big move up towards 90,000 tomorrow and the rest of the week. Okay, with that in mind, Dixie is also in play. Dollar index is finally in play. If you've been following this market for some time, I think we're going to stage a very nice bounce in the dollar now. Don't forget, everything has been stacked up against the dollar over the course of the last couple of weeks. It's been this idea that, US exceptionalism is gone. US is going to ultimately be going into a recession, and all the recession fear-mongering has come into the markets. The reality is the growth slowdown is now priced. The rates markets are pricing in one additional rate cut. And in effect, the dollar is reflecting that. We've seen quite a significant repricing in the dollar. Don't forget, the consensus play this year was long dollar. However, markets don't move in straight lines. That is the reality. And so I do think now we get a tactical buy trade opportunity in that dollar. I expect a decent bounce back up towards that 104.5. And we can see it early doors. If you go and look at euro today, look at pound today, both of them were staging a nice bid early in European session. Guess what? They're both down on the day. So both of them are showing a little bit of exhaustion there. And I suspect we are now going to get a multi-day bounce in the dollar. So long dollar is very much a good play for the next couple of trade sessions, particularly as we go into that Fed meeting. Okay, we'll talk a little bit about this, of course, at tonight's FOMC rundown, which all of you are welcome to join on YouTube live. But we'll talk a little bit about the dollar because I think that's going to be a good market to trade over the Fed. Don't forget, the Fed is adamant that policy is restrictive. They'll keep it there until they get confidence inflation's coming back to target. Okay, should they reiterate that? Again, I think that's just going to fuel more dollar long bets over the course of the next couple of sessions. Now, a little bit of chart porn for you, one that you are welcome to look at and welcome to tell your wives about, and they shouldn't worry too much about this. But a little bit of chart porn. What is chart porn? Chart porn is just when you look at a chart and ultimately you understand the fundamental landscape of it. And it's just one of those things you check in with every now and again because they're very, very sexy charts. That's why we look at it, and that's why we call it chart porn. Ultimately, what you can see in the green is 30-year yields. Now, not many of you will know much about 30-year yields because it's kind of the thing that the old pit traders used to talk about all the time, and it's also not a market I expect you to trade. It's very much just a market we lean on, okay, because it's got a very good fundamental, a very clean fundamental playbook when it comes to long bonds. Now, ultimately, we can see over the course of, well, let me reference what you're looking at. Yeah, in green, you're looking at the 200-day moving average of the long bond, okay, and what you can see is it's absolutely flatlined. So we doubled. We went from 2.1% all the way to 450, and we've literally done absolutely nothing in that long bond. Now, don't forget Donald Trump and Benson have come out and told us how happy they are to see yields, moving lower, and how sort of this is such a good thing for long-term debt in the US. The reality is they've not moved at all. Okay, and that's what this chart's telling us. It's telling us the 200-day moving average is sitting around 4.5%, and we're holding on to this really aggressive bid up that we've seen in the long bond. Okay, the longer this holds up here, and this is the key, this is the fundamental case, the longer these long bonds sit up with these higher elevated yields, the higher the probability is that the stock market is going to have a nosebleed move. Okay, that is the reality. That's why we keep looking at this chart, and of course, should these yields start to tick up, okay, at some point over this year, that is going to really be problematic for equities in general. Okay, so the long bond is just something we look at. We have obviously been in a very cyclical downtrend, obviously since the 90s, and you can see that has changed. It's fundamentally changed since COVID. COVID has changed everything ultimately. And if we were going to reference something, we're sitting at the yield levels that we were sitting at pre-2008 crisis. Okay, so just to sort of reference, are these high, are these low relative yields? They are very high yields. We've not seen this sort of a 30-year yield since the 08 crisis. And don't forget, everything is attached to these yields, particularly in the US markets. Okay, so keep a close eye on that because I think, again, yes, we've had a 10% correction in equities in the S&P. We are staging a bit of a tactical bounce. But the longer these yields sit up here, if we sit up at 450 all year, don't be surprised to see these equities really have a significant offer. Why? Well, don't forget, guys, since the 2002 rally, when we made a low point, we're still up 51%. Okay, so we could give up at least another 25% of that, and the trend is still very much intact. Okay, we've done a significant move in the US equities over the course of the last 20 years. And if you follow, for example, Druckenmiller, he often talks about the next 10 years, equity yields or equity returns should be flat. The reason is because right now, bond yields are repricing. They're doing something structurally different. Okay, keep a close eye on that. And one more chart porn for you, because I know a lot of you trade gold. And it's something I've been banging on, pardon the pun there, banging on for a while now, is that gold seems to be doing something a little bit weird, okay, and I'm sat there watching it making these record highs, and I'm not confident in this breakout. I don't believe and understand the fundamental reasons why it's breaking at this point in time. Okay, I very much firmly believe in the bull market of gold, and I understand firmly why it's rallying, but it just feels like the timing of this rally is a little bit off. And so hence, when I mentioned last week, a tactical short in gold, it was ultimately we had to get below certain levels. I think that trade remains. I think we get back below last week's highs or below $3,000. I think that is now a key area. I wouldn't be shocked to see gold have a very quick off, and I'll tell you why. What we've got in green is the gold price, and you can see we're up 52% since the start of last year. Now, what changed structurally last year? Well, the Fed came out and told us they're not prioritizing inflation. It was as simple as that, and gold is up 51% since. Okay. However, if we look at what break-evens have done, and that's what you've got in blue, yeah, you can see break-evens initially at the start of last year rallied. Why? Well, because we had the inflation scare, but then they sold off into the middle of the year when the US economy slowed. Okay. Now, what's interesting ultimately this time around is you can see, and by the way, this blue line is not just the actual print of the break-evens, it's a 20-day average, so it just smooths out the volatility. Okay, but importantly, what you can see is we're now moving back down towards the low of effectively the lowest point of this entire sort of cycle. Okay, now for me, gold has been rallying as a hedge against inflation. It's also been bidding up this year on, of course, that weakening of the dollar. I think those have been the two key drivers ultimately of gold of this, particularly the start of this year. There's also been a little bit of risk off that's playing into it. I think the fact that equity sold of 10%, that's never going to be bad for the gold market. However, we can see equities are bidding. Importantly, the dollar, like I said, is now ultimately a buy. I don't think it's a sell anymore. And most importantly, we can see those break-evens really starting to offer. Okay, so it just feels from a fundamental standpoint, this breakout to record highs doesn't make any sense at all. Now, again, it's not just blindly selling it. We don't just go up against the trend and say, look, I'm going to be smart because I know what I'm doing. It's not the case. We wait for it to get back below that 3,000. If it gets below 3,000, guess what? Everyone just bought this breakout. The CTAs bought this breakout. And ultimately, they are going to be the ones that are going to fuel that move all the way back down towards that 29.20 area. So keep a close eye on that because I think gold is very much an interesting one to watch. Now, with that in mind, of course, like I said, there's a lot going on today. There's a lot of news flow for today. So you've got to pay attention to that. Keep your headline news flow very much open. Those key plays, like I said, Bitcoin to the upside, dollar bid, and of course, keep a close eye on gold. But everything is very much about the Fed. So the markets are probably going to have another quiet session today. And of course, all the volatility and the opportunity scope should come in the back end of this week. With that in mind, if there are any other questions, do post them in the Discord channels. Otherwise, manage that risk. Good luck out there. Go make some money.